While America declared economic war on China, Wall Street was secretly funding the enemy. Not millions. Not billions. $1.4 trillion. The same years, Trump slapped tariffs on Beijing 2018 to 2020. JP Morgan and Goldman Sachs silently poured more capital into Chinese markets than the entire GDP of Russia. This wasn't a mistake. This was the most predictable financial maneuver in 300 years. And if you understand the four-stage pattern that destroyed every empire before us, you'll see we're now entering the final act, and most people won't realize it until their savings have evaporated. But before we reveal what stage 4 looks like, you need to see the machine that makes this inevitable. There exists a pattern invisible to the public, obvious to the architects that has toppled every reserve currency in recorded history. It operates like clockwork. Stage 1. Financial elite seize control of money creation through a central bank, a private institution with a government seal. Stage 2. This new power funds endless government expansion through debt, wars, programs, empires, all financed by printed money. The economy roars. Citizens cheer. Everyone believes this time they've cracked the code to infinite prosperity. Stage 3. The system overextends. The currency's purchasing power begins to bleed. Inflation whispers, then screams. Cracks split the facade. Stage 4, and this is where fortunes transfer. The same architects who built the system quietly relocate their wealth to the next rising power. They exit before the public even smells smoke. The population is left clutching devalued paper, wondering what happened. Britain, Germany, America after 1971. The script never changes. Only the actors do. And right now, as you read this, we are deep into stage 3 heading toward 4. But how do we know? Let's rewind the tape. London, 1694. Britain is hemorrhaging money, fighting France. A financier named William Paterson presents King William III with an elegant solution. Create the Bank of England. The terms. The bank loans the Crown £1.2 million at 8% interest, but the real genius lies deeper. The government creates debt. The bank transforms that debt into currency circulating through the economy. And the wealthy subscribers to the bank, they collect perpetual interest on the nation's entire money supply. A legal monopoly on money creation. Stage 1 complete. Within 4 years, Britain's national debt explodes from £1.2 million to £16 million. By 1815, after financing decades of Napoleonic wars through continuous debt monetization, the debt reaches £885 million. The lenders don't just profit, they own the British government. Stage 2 ignites immediately. Britain constructs the world's largest navy, colonizes half the planet. The pound sterling becomes the global reserve currency. International merchants settle accounts in pounds. Foreign governments stockpile pounds as reserves. The empire appears eternal. But by the mid-1800s, the Foucault begins to crack. British industrial output peaks and starts declining relative to surging Germany and America. The cost of maintaining a global empire grows faster than Britain can afford. Debt climbs again, steeper this time. And here's where the pattern reveals its ruthless elegance. The same financial institutions that built the British system begin moving their capital to America. British money floods into American railroads, steel mills, and industrial expansion. The Rothschilds finance American growth. By the time Britain officially abandons the gold standard in 1931, by the time the pound collapses as the reserve currency, the architects have already reconstructed the identical system in New York. They move the money before the collapse. Stage 4, executed with surgical precision. But if you think this was unique to Britain, wait until you see what happened in Germany and how American banks orchestrated the crisis. The Treaty of Versailles crushes Germany with 132 billion gold marks in war reparations, massive debt owed to the Allied victors. The Weimar government faces an impossible choice: raise taxes to pay it, or print money. They choose the printing press. The Reichsbank, Germany's central bank, begins monetizing government debt, paying striking workers, funding social programs, keeping the fragile political coalition from imploding. When France and Belgium occupy the Ruhr industrial region in January 1923 to seize coal and force payment, Germany's response is defiant: pay Ruhr workers to strike. Pay them with freshly printed money. The money supply goes apocalyptic. May 1923. 8.6 billion marks in circulation. June, 17 billion. August, 669 billion. November, 400 quintillion. By November 1923, $1 buys 4.2 trillion German marks. A wheelbarrow of cash won't buy a loaf of bread. Workers demand payment by the hour because their wages evaporate by the end of their shift. Prices rise during working hours. The middle class is annihilated. Life savings vanish like vapor. But here's what they don't teach you in school. This wasn't accidental policy failure. Rudolf Abenstein, the Reichsbank president, deliberately bought foreign currency with marks at any price, regardless of inflation. The government claimed this was necessary to pay reparations. British and French advisors said it was deliberate currency destruction. Later records confirmed it. The hyperinflation was useful. It eliminated domestic war debts. It destroyed the politically inconvenient middle class. When the crisis peaked and Germany introduced the Rentenmark in November 1923 to stop the bleeding, the solution required American loans. The Das Plan of 1924 brought Wall Street into Germany to restructure everything. U.S. money flooded in through the late 1920s. American banks and corporations gained massive exposure. Then when that system collapsed in the early 1930s, creating the conditions that brought the Nazis to power, those same American financial institutions were already positioned for the next phase. Same pattern, different century. Central bank monetizes government debt. System expands through inflation. Currency collapses, foreign capital restructures during the crisis, then exits before the political disaster. But the most important example, the one that created today's system, happened in 1971. And it's the key to understanding what's happening right now. Bretton Woods, New Hampshire, 1944. Representatives from 44 nations design a new monetary order from the ashes of World War II. The US dollar is pegged to gold at $35 per ounce. Every other currency pegs to the dollar. Foreign central banks can redeem their dollars for physical gold at that fixed rate. The dollar becomes the global reserve currency, backed by the largest gold reserves in history at Fort Knox. For 2 decades, it works flawlessly. Europe and Japan rebuild. The dollar circulates globally. American economic dominance is absolute. But then the U.S. starts using its ability to print the reserve currency to finance the Vietnam War, the Great Society programs, and the Cold War military buildup, all without raising taxes. The Federal Reserve expands the money supply. Interest rates stay artificially low. Dollars flood into foreign central banks as America runs bigger and bigger trade deficits. By 1971, there are far more dollars circulating than the U.S. has gold to back them. France sees what's happening. Under President Charles de Gaulle, they start demanding gold for their dollars. In August 1971, President Georges Pompidou sends a battleship to New York to collect French gold. Switzerland exits the system on August 9th. On August 11th, Britain requests $3 billion in gold transferred from Fort Knox to New York. Paul Volcker, then Under-Secretary of the Treasury, said later that when Britain, the country that founded the system with the U.S., started taking gold for dollars, everyone knew it was over. By August 15th, only 10,000 metric tons of gold remained in U.S. reserves. August 15th, 1971. Sunday evening, Nixon goes on television and announces the U.S. is temporarily suspending dollar convertibility to gold. The gold window slams shut. That temporary measure still in effect today. The Bretton Woods system collapsed. By March 1973, the world moved to floating exchange rates. The dollar became pure, fiat currency backed by nothing except government promise and U.S. military force in global oil markets. Since that day, the dollar has lost over 98% of its value against gold. In 1971, gold was $35 per ounce. Today, it's over $3,000. Same pattern. System overextension. Loss of monetary discipline. Currency debasement. So now let's apply this pattern to what's happening right now and you'll see why. Wall Street's $1.4 trillion move into China wasn't random. July 6, 2018. Trump imposes the first tariffs on Chinese goods, $34 billion worth. The trade war officially begins. Both parties rally behind it. The establishment is united. America is finally going to stand up to China. But July 6, 2018 is significant for another reason. It's exactly 1 month after June 1, 2018, the day MSCI, the company controlling global investment indices, officially started including Chinese shares in its emerging markets index. When MSCI includes a market in its indices, institutional investors who track those indices must allocate capital to that market. Pension funds, sovereign wealth funds, university endowments, insurance companies, trillions of dollars that simply follow the index. China's weight in the MSCI Emerging Markets Index went from essentially 0 to 43% by October 2020. During the same period, 2018 through 2020, U.S. portfolio investment in China hit $1.4 trillion. Peak year 2020. The trade war at its hottest. BlackRock expanded its Chinese operations throughout this entire period. JP Morgan secured approval for a majority-owned securities business in China. Goldman Sachs increased its stake in its Chinese joint venture. These aren't accidents. These are the same institutional structures that operated through Britain, through Germany, through post-war America. And they're executing stage 4 right now. Let's check the boxers. U.S. national debt, $36 trillion. The to GDP ratio, 98%. The Federal Reserve's balance sheet was under $1 trillion in 2008. It exploded to $9 trillion during COVID, still above $7 trillion today. Same mechanism as always. Central bank monetizes government debt. Government spends far beyond what taxes can cover. Currency supply expands way beyond productive capacity, and the financial institutions that run this process start moving capital to the next power center. Stage 1. Federal Reserve established 1913. Monopoly on money creation. Stage 2. Decades of debt monetization financing wars and programs globally. Stage 3. System overextended. Debt at 98% of GDP. Currency debasing. Stage 4. Financial institutions moving capital to China while Washington performs theater. We are here. Right now. The pattern does not care about your political preferences. It does not care whether you believe in American exceptionalism or technology saving us, or modern monetary theory. This time is not different. The mechanism is mathematical. The trade war was theater. It was designed to appear as if America was resisting while the actual financial integration accelerated behind the curtain. You cannot fight China with tariffs while your largest financial institutions move record capital into Chinese markets. You cannot reshore manufacturing while index providers who control institutional allocation are increasing China's weight in global portfolios. You cannot maintain dollar hegemony while running trillion-dollar deficits financed by central bank money printing. The contradiction is not an accident. It is the mechanism. The British population did not understand in 1880 that their capital was building America. The German population did not understand in 1929 that American banks had facilitated their hyperinflation cycle. The American population does not understand now that Wall Street is building China's financial infrastructure while Washington performs resistance. But the pattern does not require your understanding. It simply executes. By the time this becomes obvious to the mainstream, the repositioning will already be complete. The current system, the dollar as reserve currency, American financial dominance, the post-Bretton Woods order is not permanent. It is stage 3 of a 4-stage pattern. And stage 4 is executing right now. The next 5 to 10 years will not look like the last 30. The mechanism is accelerating. The debt cannot be repaid. The currency will continue to debase. The financial elite are already positioned. The only question is whether you understand the pattern clearly enough to see it happening in real time and make decisions that account for the inevitable outcome. This is not prediction. This is pattern recognition. The same mechanism that moved British capital to America in the 19th century. The same mechanism that moved American capital into Weimar Germany before the collapse. The same mechanism that moved capital out of the U.S. as Bretton Woods failed is moving capital into China right now. While politicians argue about tariffs, while think tanks debate decoupling strategies, while the media obsesses over trade war optics, Wall Street has already decided. $1.4 trillion has already moved. And the pattern which has never failed to complete itself is 3/4 through its execution. The population will hold the currency as it approaches zero, while the architects of the system have already moved their wealth to the next power center. That is the pattern. That is the mechanism. And that is what is happening right now while everyone watches the political theater and misses the systematic wealth transfer occurring behind it. The machine is already in motion. The question is, will you see it before it's too late?